Hi, I'm Amberly Mason, and in this edition of the 3-Minute Trading Expert Series, I'm going to cover one of the safest, most profitable trading strategies in the world. I'm going to show you how you can safely make huge returns trading an asset as it goes from bad to less bad. The bad to less bad trading strategy amounts to finding assets that have been hammered for some reason, be it a natural disaster, a broad market sell-off, or a long industry downturn. Then buying them after the market has bottomed and making tremendous returns when a bit of normalcy returns to the market, when conditions get a little less bad for the industry. It's one of the greatest trading strategies on the planet. You see, when an asset suffers a major sell-off or has suffered through an extended bear market, people say things are bad for that asset. Nobody wants to buy it. You'll never see that asset on a mainstream magazine cover because publishers know having it on their cover would gross out readers and potential newsstand buyers. Mention the asset to friends at a cocktail party and they'll recoil in disgust. It's around this time when most folks can't stand the thought of buying that asset that it can start trading for less than its real intrinsic value. It will get very cheap. All it takes for your investment to rise 50, 100, or 200% is for things to get less bad. In addition to large upside, these situations also offer plenty of safety. When extreme pessimism surrounds an asset, there's little downside risk to your trade. Everyone who wanted to sell has already sold. The selling pressure is exhausted. The risk gets wrung out of the trade. Let me show you an example. In the summer of 2010, one of the worst environmental disasters in U.S. history occurred in the Gulf of Mexico. The Deepwater Horizon oil rig exploded, killing 11 workers and sending huge amounts of crude oil into the ocean. It was a horrible situation with the worst headlines an oil company could imagine. It hammered the share prices of many of the world's best oil-producing and drilling companies. Even companies with modest business exposure to a drilling moratorium in the Gulf fell 50% in just a few months. BP, the majority owner of the well, fell 55%. Transocean, the drilling company that owned the rig, fell more than 50%. It was a bad situation. But for investors and traders who know bad to less bad trading, it was an opportunity to buy great companies at discounted prices. Drilling companies started selling for discounts to their book values, or absurdly cheap earnings multiples, like 4 or 5 times earnings. It was a bad time, and it was time to buy. Transocean rallied 90% off its bottom. BP rallied 80%. Again, these stocks were so deeply depressed by all the negativity, they were like coiled springs, ready to shoot higher when things got just a little less bad. Now, bad situations aren't just headline-grabbing disasters. Bad conditions can also occur because of a long-term bear market in a sector. For example, in 2001, the gold stock sector had been in a long bear market. The sector had endured decades of depressed gold prices and meager profit margins. When an asset spends that many years in a bear market, folks give up on it. In gold's case, nobody wanted to own gold or invest in a gold mine for over 15 years. As hard as it is to imagine now, there was extreme pessimism toward gold in the late 1990s and early 2000s. It was the definition of bad. But look at what happened in 2001. Things started getting less bad in the gold business. Gold moved off its bottom of $250 an ounce and advanced to $1,000 an ounce by 2008. Gold stocks staged an incredible bad to less bad rally. Elite gold companies like Royal Gold and Goldcorp climbed more than 1,000% during these years. They were at depressed levels. When things got less bad, they soared. Of course, nobody is right on bad to less bad opportunities all the time. And using a stop loss ensures that you have a plan in place to deal with adverse conditions, and that over a lifetime of trading bad to less bad situations, you make a lot of money when you're right and lose a little bit of money when you're wrong. But it's important to emphasize that you make the biggest gains as things go from bad to less bad, not less bad to good. You make the biggest gains just when a glimmer of light appears, not when the whole sun comes out. You have to be willing to get in there and buy when it feels uncomfortable. If you wait until the news gets rosy and people realize it isn't the end of the world, you're going to be too late. You're going to miss out on the big, easy, early gains. You have to buy near the point of maximum pessimism. Just thinking about buying something in a bad condition might make you feel sick to your stomach, but the seasoned trader knows that that feeling is often a great buy signal. I'm Amberly Mason. Thanks for watching, and good trading. If you want to learn another incredibly powerful trading secret, click here to watch the next video.